Hello, good evening, everyone. Today, I'm going to have the last section for the Wednesday online meeting. So I didn't receive any students asking any specific questions. So I thought maybe I would just go through a couple questions that I think are important questions that you really need to know. So the first question is about calculating a bond's real return. Okay. So in this question, a bond par value is 1,000. The coupon rate is 6.3%. And the bond price was under 950 at the beginning of the year, and at the end of the year, 984.56. The inflation for the year was 2.1%. What was the bond's real return for the year? Okay, so you can calculate the nominal return, right? You can calculate nominal return. And then you factor into the inflation factor, right? And then you can calculate the real return. So the first thing you want to do is to calculate the nominal return. Well, for a bond, you have a little bit of capital gain here, right? So that bond appreciate from the price appreciate from 946.86 to 984.56, right, for the year. So that's a gain here. But also, you have a coupon, right? You received some cash payment. So 6.3% on $1,000 value. So that will be $63, right? So you have a capital gain plus a coupon interest payment. So that's the total income divided by your initial investment. That's the bond price you paid at the beginning of the year. So you get a bond return to be 10.64%. Okay, and now this is just a nominal return, right? So now what's the relationship between the nominal return and the real return? Well, in this case, the equation is established as this. So 1 plus your nominal return equals 1 plus your real return times 1 plus inflation rate, okay? So your real return, that's the lowercase r, and f representing the inflation rate. And the capitalized R, that's your nominal return. Okay, so in this question, we just calculate the nominal return to be 10.64%. And the inflation rate F, that information is provided. That's the 2.1%. So using this equation, we are able to calculate the real return R. Okay, so I'm going to use this information, and the real return is calculated to be 8.36%. Okay, so the nominal return appears to be 10.64%, but that also consider there are 2.1 inflation. So the real one is actually 8.36%. Okay, so make sure you know this. The next question is really about the probability of the states of economy and what is their variance. Okay, so in these situations that there are 3 possible states: recession, normal, or boom, right? So before the event, before we know the outcome of the event, there are 3 possible events, and they have they lead into different outcomes, right? So for boom, you have a 21.8% return, normal 10.8%, and recession is a loss 9.3%. Okay, and for each possible outcomes, the probability information is also provided. 25% for recession, 44% for normal, and 31% for boom. Right? So in this question, what is the variance, right? What is the variance? So we are first calculating the expected return. So you apply the probability for each outcome to the outcome return, right? So that would give you the expected return. So it goes like this. Okay. So basically, you apply the middle column. These are the probability to the outcome, the returns. Okay. And then you add them together. That gives you 9.19%. This is your expected return. And then when you calculate the variance, okay, so variance is actually, there are three possible outcomes. So they're going to be three terms, the sum of three terms, 1, 2, and 3. Okay, so for each term, that is the return for that scenario. Okay, so in this case, the first term, that's about the recession. Right? For recession, it's a loss, so it's negative 0.093, and minus the expected return, which we just calculated, 0.0919. So and then you square, you take the square, okay, and this term, this squared term, you also need to apply the probability 0.25. Okay, so the second term, the calculation is about the normal state, and the last term is about the boom state. Okay, so then I have variance calculated to be 0.0134559. So make sure this is, you know how to do this, right? This is really important. The next question is about BNet company has a potential new project that is expected to generate annual revenues of 255,800 with variable costs of 141,200 and fixed costs of 59,200. To finance the new project, the company will need to issue new debt that will have an annual interest expenses of 21,000. Okay. So the annual depreciation, so that will be 23,800, and the tax rate is 21%. What is the annual operating cash flow? So in this case, you have the revenue, you have the cost, the information, so including the variable cost and the fixed cost. And you also know the interest expense, okay, and the annual depreciation. So the tax rate is 21%. What is the annual cash flow? Okay. So we are using the tax approach. Okay. We are using the tax approach. Okay. So just give me 1 second. Okay. So in the tax approach, operating cash flow equals sales minus costs. And this cost does not include any non-cash cost, such as depreciation. Right? So sales minus cost, and then times 1 minus tax rate, plus the T times depreciation. Okay, plus T plus T times depreciation. So how does this formula, where is this formula coming from? So we always go from the very beginning. The very beginning, this is kind of the ancestor equation, right? All the equations come derived from this general equation according to the definition. So operating cash flow equals EBIT plus depreciation minus taxes. So what is the EBIT? EBIT equals sales minus costs and minus depreciation. So again, this cost does not include any non-cash expense, non-cash items, right? So that's the EBIT. And what is your taxes? Okay, what is the taxes? So taxes will be, okay, EBIT times T, okay, EBIT times T. That's the taxes. So that's equals sales minus costs minus depreciation times T, right? So EBIT times T. So when you bring EBIT and the taxes into this original equation, okay, into this original equation, so what you got is sales minus cost times 1 minus T, okay, and plus T times depreciation, okay, T times depreciation. Okay, so now let's bring all this information in. So sales, that's 250,800, minus your variable cost, 141,200, and minus your fixed cost. So that's the 59,200, okay? And you times 1 minus T, 1 minus the 20% tax rate, 0.21, plus T is 0.21, 21%, times depreciation, 23,800. So your operating cash flow is 48,764. Okay, 48,764. Okay, so the last question is about calculating the debt to equity ratio, right? So sometimes you were given the information about debt to equity ratio, and they ask you to calculate WACC, right? But they could ask you the other way, right? So in this question, they provided you WACC, okay? That's called weighted average capital cost. And they want you to calculate what is the debt to equity ratio. So you just have to know the calculation either way, right? So in this case, the weighted average capital cost equals, is given 9.19%, which is 0.0919. And if you assume the weight of the debt is XD, so then the weight for equity will be 1 minus XD, right? Because the weight of debt plus the weight of equity should equal to 100%, should equals to 1. If we assume the weight of the debt is XD, so the weight for the equity will be 1 minus XD. And you know the cost of equity, that's the 12.6%, plus the cost of debt, pre-tax. This is really important, pre-tax, right? The pre-tax cost of debt is 5.7. So you have to consider the tax shield, right? So 0.057 times the tax shield, 1 minus 21%. And then you times the weight, XD. So using this equation, okay, you can solve that the weight for XD, so the weight of the debt is 42.11%. Okay, so what is the weight, right? The weight is the debt over assets, right? And what is the asset? A equals debt plus equity, right? So A equals D plus E, right? So we figured out XD, that's the weight of the debt, and that equals D over D plus E. So that equals 0.4211. So then I multiply D plus E on both sides, only D left on the left side, and 0.4211 times D plus E. And now I break the bracket, So there is the 0.4211 in front of D plus the same number in front of E. Now I'm gonna move all the D to the left side. So D times 1 minus 0.4211 equals 0.4211 times E. So now my D over E, that is what I'm looking for, that's the debt to equity ratio, will equal to 0.4211 divided by 1 minus 0.4211. So that is 73%. Okay. So you can see you have done some questions that you start with the debt to equity ratio, right? And then you can calculate the weight of debt, the weight of equity, and then you can calculate WACC, right? So in this question, they give you a WACC, they want to ask you what is the debt to equity ratio, right? So I found this is interesting. Make sure, regardless, what is known, what is unknown, you should be able to use the equations to solve the unknowns using the information given, right? So yeah, that's what I want to talk about. So these 4 questions are important. I wish you find that this video is helpful. If you don't understand, make sure you contact me or you do a little bit more work, study it, right? This is really important. Okay, that's it for today. There's no student coming and no specific questions were asked. So I just picked these 4 questions I think is important for you to review. Okay, that's it. Have a good evening.